Welcome back to Editor's Edition. I'm Jesse Baines with Yahoo Finance Canada. Today, we're talking about real estate during COVID-19, which has been, well, I'm running out of metaphors to describe, frankly. Realosophy Realty's John Pasalis is here to bring us up to speed on the Toronto real estate market. Hey, John, thanks for being here.
Thanks for having me.
And from all the way across the country, we have Oakland Realty's Steve Saretsky in Vancouver. Thanks for being here, Steve.
Looking forward to it.
Today, we'll continue to dig into topics including whether or not we're in a bubble, rising mortgage rates, low rise and condo markets, fiscal and monetary policy, and so much more. But let's begin with a bit of an introduction. I know, weird, it's like our 9th episode, but it's important that we talk about John and Steve's approach when it comes to navigating these real estate markets. John relies heavily on data. In fact, he's working on a PhD. So tell us, John, how do you apply and use data when it comes to looking ahead for trends and whatnot in the Toronto market?
Yeah, so I mean, my approach is a little bit different. If you look at how most economists look at the housing market, they tend to try to understand what's going on at the GTA, so the Greater Toronto Area level, and they're analyzing the entire market and these big macro trends. What I do and what our company does is we try to take it. The problem with this, of course, is let's trying to like analyze the stock market without looking at the underlying stocks beneath it, right? And you're just looking at the index. That's the problem with, I think, what most macro economists do. So we try to take a far more micro look by looking at what's going on the ground level, across house types, across regions, across neighborhoods, to better understand sort of what are going on in the micro trends, because condos downtown are doing something different from condos in the suburbs. Houses are doing something different from condos. So by understanding some of these really smaller micro trends and analyzing millions of transactions, we try to get a better understanding of what the market might be looking like in 3 to 6 months, based on sort of the trends that we're seeing today. So that's really kind of how we approach the market, is trying to look at some of the trends that might impact house prices tomorrow by looking at it at a very granular level.
And you're working on your PhD, right? Tell us about that.
Yeah, I mean, and that's pretty much what it's about. I mean, it's really just taking a micro analysis and both looking at sort of some of these trends, but also looking at how things like behavior of investors might be impacting house prices tomorrow, how they might be pushing prices up. And that's really what a lot of my sort of research for my thesis is looking at sort of these things at a micro level and trying to understand the dynamics that might be impacting house prices tomorrow.
And Steve, I know you also use a lot of data in your approach. You're into macroeconomics. And so how do you apply those things when it comes to real estate in Vancouver?
Yeah, I think it's a little similar to what John said. Like, I think data is the new oil. So, I've spent thousands of dollars compiling our own set of data, database here, basically aggregating a lot of the data. But it's one thing to look at the data and sit in your comfy chair and pontificate about the market. But, for me personally, I'm also like on the ground, front lines, dealing with clients on a day-to-day basis. I'm actively investing in the market as well. So, sometimes it's taking the data from a higher level, and then also like you do need like the on the ground anecdotes, I think, are equally as valuable. So I think it's like combining those two to try to, I wouldn't say front run the market, but really try to hone in on the market and understand, where things are and where they could be going.
Right. Okay. And speaking of on the ground, let's take a look at the latest national stats from the Canadian Real Estate Association, CREA. Sales up 6.6% month over month. Prices up 3.3% month over month. That's the fastest price increase, the largest price increase month over month ever. And 3.3% might be a good year in some markets, but that's in 1 month. So like, I mean, you imagine $1 million house, that's like a couple of $100,000 right there. John, when prices are so high, bidding wars abound. Why are people in such a frenzy to buy homes these days?
I mean, I think there's a there are a lot of factors. I mean, one is just, I think COVID has made a lot of people who maybe were renting in high rise wants to move into a low rise home and move out of the city. But I think the bigger factor right now is rates are incredibly low. And, the messaging from Ottawa is that prices are pretty much only going to go up in the future. And I think it's creating this anxiety among home buyers that they need to buy a house now or they're never going to be able to afford one. When you see prices rising in the suburbs now, they're going up 30% per year. So if you wait a year, you're going to have to spend, $300,000 more for a home is how most people think. And I think that's really pushing a lot of buyers forward, and it's creating an unbelievably competitive market.
Yeah, I mean, I should point out, as you say, so a lot of all markets aren't marching to the same drum, like Woodstock within those Korea numbers, up more than 35%, some markets 50%. It's unbelievable. Steve, what are you seeing in what's your take? Like, why are people, is it rates? Like, why are people in such a rush to buy a home right now?
Yeah, I think that, I think first and foremost, it starts from like policy decisions, out of Ottawa. I think if you look at it, like the pandemic happened and everybody was freaking out and, talking about Great Depression 2.0. And so it was pretty evident if you look at the policies that our regulators made is they wanted to get banks lending money. They needed to get credit out the door. And if you look at, again, residential mortgage credit growth running at 10-year highs, that combined with the low rates, obviously, surprisingly encouraged people to take on more debt. And so people were kind of looking at it and saying, well, pandemic, want more space, life is short, and the banks are just pumping out money. So people were kind of leveraging that money to get into the housing market. And as John pointed out, as soon as you start getting like price increases, particularly rampant price increases like we're seeing, there is this element of fear of missing out. I mean, the Fraser Valley, detached benchmark, suburban detached houses officially are up 20% year over year. But I would argue, again, that's a lagging indicator, and you're probably closer to 25 or 30%. So when people say, oh, okay, houses are up, 25, 30% over the last 12 months, it's kind of that recency bias where people think it's going to continue. And there is an element of fear that they're never going to be able to afford a home, and what kind of life are they going to have for their kids and the people that follow behind them. So yeah, I think it's just people prioritize shelter, and when prices are rising as fast as they are, it scares people.
Yeah, and I should point out, you make a good point about the being a lagging indicator, but the price increase I mentioned there is the MLS index, and that strips out for housing types. If you looked at detached, it would be much bigger. If you looked at the average sale price, it would be bigger. But Steve, I love putting you guys on the spot, so let's just get right to it. The B word. Are we in a bubble?
I think that there's certainly elements of it, yeah. I think that anytime you have price appreciation of, like I said, in the suburbs, close to 30%, I mean, that's euphoric-like activity. So I do think that I wouldn't be surprised if we have a pullback here in the next 12 months. I could easily see prices being, if you bought at the peak frenzy of it, that you could easily be down 10% next year. I don't think that's unquestionable. Obviously, a lot of this is going to come down to, quote unquote, don't fight the Fed, right? I think central banks are playing a larger and larger role in our markets, and everybody's just looking at the central banks and saying, well, let's watch and see what they do, and then let's follow them.
Right. A good reminder that the housing market isn't necessarily the economy, because the economy and the job market, I mean, we're talking about over 8% unemployment. We're sort of celebrating because it's the lowest since March 2020. GDP was minus 5.6% or something like that. John, bubble, yes or no?
Yeah, I mean, without a doubt. I mean, but certain segments, again, I think the one thing I'm cautious about with the bubble word is that it's not, to say that Toronto's a bubble is not entirely true. The only segment in Toronto that seems like it's a bubble and is the suburban housing market. The downtown housing market, I don't know if it's quite a bubble. The condo market across the GTA is not quite there yet. Like, it's probably going to move there. So certainly, I mean, when we look at this segment of the suburban housing market, I mean, if prices are rising 30, 40%, I mean, honestly, if you're not going to call that a bubble, I mean, you're just rationalizing irrational exuberance, really, which is what some bank economists are doing now, which is, I mean, arguably yet another definition of a bubble when we rationalize the irrationality. So certainly when you're seeing 30 to 40% price growth, it's not a rational rate of appreciation. Right.
And, so you talked about exuberance there. It's a good time to throw a clip of the Bank of Canada's Governor Tiff Macklem. Doesn't seem too worried about things. Let's have a listen.
So when we see extrapolative expectations, when we see people starting to buy houses solely because they think the prices are going to go up, that is a warning sign for us. We are starting to see some early signs of excess exuberance, but we're a long way from where we were, say, in 2016, 2017, when things were really hot.
Early signs of excess exuberance. What do you think?
I mean, I think they're really far behind. The early signs were in the fall. Like, this is quite obvious excess exuberance. Prices are way up, like I said, over 30% in a lot of regions across the country. It's not even just Toronto. So again, when he says it's nothing to worry about, it's not as crazy as 2016. I mean, I think he's completely wrong. It's probably significantly hotter than it was 4 or 5 years ago.
Steve, what message does it send to buyers or people that are looking to get into the market when he says excess exuberance? Does that sort of signal that it's not too late, jump in, it's not crazy town yet?
I just think that these guys I think that they're order takers. Obviously, they're taking their cues from the Federal Reserve in the U.S. and other global central banks. So I think, like, realistically, as much as maybe they should or they want to raise interest rates, like, they can't. And I think it's more Tiff Macklem's way of saying, hey guys, let's we're keeping our eye on it, and if it gets too crazy, like, we might have to start doing something. So I just think it's all kind of semantics. I think, again, obviously anyone that's on the front lines is well aware. Anyone that's trying to buy a home right now is well aware of what's happening. And I almost think it's 2016 on steroids, except you don't really have a whole lot of fundamentals at play right now. So I just think that we've got a lot of credit flowing into the housing market. And, once the housing market gains momentum, we've talked about before, but it's been, 30 years of a bull market. And every time somebody comes out with a housing bubble call, it seems to rip higher. And I think Evan Siddall at CMHC was astute in his call last year at the onset of the pandemic that we should have probably seen a decline in house prices. And by not getting one, I think it's stoked even more euphoria.
Yeah, and I mean, you mentioned 2016 on steroids, Steve. But one of the things that we've talked about throughout the course of the shows that we've done is that that was a lot more investor driven compared to today, where it's more end user driven. But are investors jumping into the fray now? I mean, it seems pretty attractive if I were an investor to see house prices rising 30+% in some markets. Steve?
Yeah, I think there's certainly feedback loops, right? I mean, at the onset of the pandemic, like particularly downtown, right, we saw investors starting to panic, some of them selling at the lows. And now that everybody's looking around and going, holy smokes, like, nationally home prices are up 17%. In Greater Vancouver, house prices and townhouses are ripping through the roof. It's only a matter of time. I think the investors have figured out, wait a minute, it's only a matter of time until the condo market takes off. The Bank of Canada says they're not going to raise rates till 2023. Holy smokes, I better get back in. And so now we're seeing, like, for example, in the downtown Vancouver condo market, the one bedrooms, everything is going multiple offers now. So the investors are definitely back in the market. And I think that, again, it's sort of a positive feedback loop. The more investors come in, the more prices go up, and the more it draws even more investors in. So it's early signs in terms of the investors coming back to the market, but they're here.
John, are you seeing investors coming back to the market in the GTA?
Yeah, 100%. I mean, I can't even count the number of people who are contacting us wanting to buy an investment property now. And I think that's been a big shift over the past few months. I mean, before that, when the market started to rebound in June, it was mainly end users. But like you said, I mean, like Steve said, I mean, there's a feedback loop. When you see prices rising 30% per year, it's just going to fuel more speculative buying, because, I mean, you can't really beat a leveraged asset that's rising 30% per year. I mean, it's an amazing return. And I think the challenge is, and I think Steve touched on it, I mean, the problem right now with the Bank of Canada is I don't even think it's so much about policy, because I agree with Steve, like, they can't really raise rates. I mean, they have to worry about the whole economy. I think the biggest mistake they're making is that they're fueling this very exuberance that they're saying they're worried about. Like, when you listen to sort of Governor Macklem's message about they're worried about people's buying because they just assume prices will rise and they'll keep going up. I mean, this is the message he's sending to people. He's basically saying, prices aren't too high now. Don't worry about it. It's not like 2016. They'll just going to keep going up because we're going to keep rates low and we're going to keep this economy pumping. So they're actually fueling the exuberance that they say that they're worried about. And to me, that's the biggest mistake that they're making. And I think that's what's driving a lot of the investor demand we're seeing, because they're taking cues from Ottawa.
Can I just chime in for a sec?
Yeah, please do, Steve.
Well, I mean, how many times has he come in and said, particularly at the onset of the pandemic? At the onset of the pandemic, obviously it made sense. But how many times, even more recently, he'd come out and says, Canadians can rest assured, if you're looking to make a big purchase, interest rates will stay low for the foreseeable future. Interest rates stuck at zero until at least 2023, and QE will remain on the table until the recovery is quote unquote well underway. So they kind of keep doubling down on this message. So like, again, if you're an investor and saying, holy smokes, this guy's guaranteeing me basically rates are going to stay low for the foreseeable future, why the heck would I leave my money in the bank? I better keep plowing more into these condos because like they only go up and the government just keeps supporting the market. So it's like, and the bigger that it gets, it's like, I think people kind of know that the bigger it gets, it's like the more inclined the government almost has to support it. So it's kind of this, I think investors have kind of figured it out.
So the Bank Canada has signaled that its overnight rate isn't going to change till 2023, I believe, or at least until it reaches its inflation target, which it assumes so it won't happen until 2023. But there's this new thing creeping into the market, inflation. We're seeing bond yields starting to rise. The big banks raised the fixed mortgage rates around 10 basis points, depending on the duration. Is that enough to change sentiment, John?
I mean, I think eventually it might cool the market a little bit. I don't think it's going to have a significant impact. Like at the end of the day, people are still qualifying at the stress test rate. So the increase in rates has zero impact on people's borrowing ability and capacity. It just means you're going to pay a little bit more on their mortgage right now. And I think the momentum of fear of missing out and getting a house and getting into this market is going to outdo a 50 basis point rate hike. So I think if we go another 50 basis points, it might take a little bit of the heat off, because the big difference if you're paying 2.5% versus 1.5%. But again, I think it's right now, I think the market's still too hot.
Steve, do you think inflation is going to be the pin that pops this balloon if we are in a bubble, I should say, if we are in a bubble?
Yeah, I mean, I think that the biggest difference is I would probably disagree with the way that we measure inflation. And so I think that, the Bank of Canada is obviously saying, well, there's not really any inflation and, it's sub 2%. But I think in a lot of things, particularly in the housing sector, I mean, you've got rampant inflation, but, certainly yields going up. I think that, they're up from 1.5% to about, close to 2.2 now. So it's certainly a decent move that I think has made a few buyers maybe think twice. But, unless mortgage rates get back up to say 3 and start going north of that, then I don't really see that. But my personal view, where I disagree with people and where I get in arguments with people on Twitter, is that I just don't see a scenario where the Bank of Canada is just going to let the free markets do their thing. I just think that they're going to come in. They've already talked about yield curve control being in their toolkit. And I think that, hey, if inflation scares the market and yields keep backing up and you get mortgage rates at 3%, I think that I believe anyways that the Bank of Canada will be prompted to step in, and we'll see how successful they are with that.
Okay, so we've talked a lot about how Canada's economy is reliant on real estate, residential real estate. So let's take a look at BMO Salguatieri broke down some data about GDP reliance. Canada's housing market is on residential structures currently 9.3%. Now the long run mean 5.9%. The US currently only 4.6%, and at the peak of the housing boom, 6.7%. We know how that ended. Canada is more money is being spent on residential structures than on things like outside of residential structures, machinery and equipment, buildings for businesses. That can't be, I mean, I shouldn't say it's not healthy for an economy, but I'll let you guys say it, if it is or isn't healthy for a long term for our economy, John.
No, I mean, definitely not healthy. I mean, and a chunk of that, when you break it out, a big chunk of that is actually just transaction costs on real estates that are just changing hands, so commissions. So this is not positive. I mean, it's not, I'd rather not have our industry driving that much of our economy. And it certainly would be better if we saw more money in more productive industries. But I think this is just, again, this is part of our federal government's plan. I mean, they're leaning on housing to kind of pull them out of this economy. And I think the problem is it's very short-sighted. I think they're just looking at the near-term gains of escalating house prices. And I think it's just setting us up for potential bigger problems down the road.
On Twitter, Van Re-analyst, Conor McGregor picture with the Bitcoin eyes. I don't think it's Conor McGregor. I don't think he's interested in Vancouver real estate. But anyways, he asks, and we sort of touched on this, the lag in home price indexes. This is detached home buyers. Stats say prices are up 10% year over year, yet in reality, it's closer to 25%. How does that mess with people's heads, Steve?
I don't know if it messes with people's heads, but I think it's, again, it's a rear view picture, right? So it's like the policymakers are going, well, it's only up 10%, to early signs of exuberance. So it's like, no. I mean, if you're actually on the ground making offers for clients and you run the sales comps by logging into your MLS system and knowing what the house down the road sold for 3 months ago, you can tell that, again, like it's significantly. So what I have, so I'll give you like a sort of an anecdotal story from on the ground. But like I've got a client where, we're looking at houses and we run the comps, the sales comps. We go, okay, the house is worth 1.6. But in reality, it's like every 2 weeks, the prices are moving up. So they feel like it's just like this moving target. So it's like the comps start to become irrelevant. And people go, well, if I don't pay 1.7 for the house today, someone will. It'll be worth 1.7 in 2 weeks. So let's just push it there now. And so that's why house prices just accelerate so rapidly on the way up. And obviously, we're seeing that now. So similar to 2016-17, is the run up on the way up is very, very quick because the comps just is such a quick moving target.
Okay, and Steve, this one's for you as well. This is from Norman, the bus driver. I love these handles. What's the outlook for condos outside Van downtown? So Surrey, Langley, Abbey, I guess that's Abbotsford. Inventory, pre-sale were very high since 2017 had quite a bit of a headwind since, Steve.
The condo market right now, especially in the suburbs, is hot. I mean, the sales to actives ratio in Greater Vancouver last month in February was 46%, which is indicative of a very strong seller's market. That's the highest reading we've had since early 2017. And we had very, very rampant price acceleration in the condo market in early 2017. So in my view, the condo market is now, the last several months in particular, it's become very obvious. It's following the rest of the market, right? I mean, you can't have houses and townhouses going up 20, 25, 30% and think the condo market's somehow just going to stay flat. So I think a rising tide lifts all boats, and that's what we're starting to see in the condo market.
And for John, Mr. K. Rangachari asks, and we sort of touched on this as well, inflation and attractiveness of real estate, I guess, do they go hand in hand? Remote working and buying properties in rural areas, is the remote working trend going to continue?
Yeah, I mean, I'm not optimistic that it's going to continue forever. I mean, at the end of the day, I think people will start going back to the offices, whether their employers make them or whether they want to, even 2 or 3 days a week. I mean, I don't think we're going to go back to normal anytime soon. But I think everyone who bought rural properties expecting to never go back to an office, I mean, I don't know if that's going to happen. And I think that could put a little bit of pressure on people tomorrow if they need to commute 2 hours to get to work each way. So I think that's going to be one sector of the market we need to keep an eye on, because a lot of people bought cottages and expecting to live on the cottage for the next 20 years. And I don't know how that's going to work out once offices open up again.
Yeah, I can imagine it could be a rude awakening if your boss suddenly says, well, get back to the office, or you lose your job and your next boss won't let you work from home. That could be tricky. So I want to move on now to another recent, it was a report about affordability, a global report about the least affordable, and Canada ends up with the dubious distinction of making these lists time after time. But if you take a look at the list, Hong Kong was the least affordable, but it didn't get any more unaffordable. Vancouver did get slightly more unaffordable. It's number 2. Sydney, number 3. Auckland, New Zealand, number 4. And then Toronto, 5. 2 out of 5 of the most unaffordable global cities. John, when people that are young, just starting out in their careers, a lot of those jobs are in the cities, like in Toronto. What do you think that makes them feel?
You know, it's terrible. I mean, it's funny. Someone emailed me the other day saying, listen, we're a young family. We have a max budget of $700,000. We want to buy a home, but we can't afford one in the GTA. And I actually looked at the entire Greater Toronto Area sales this year, and fewer than 3% of houses that sold were under $700,000. And that's a very broad area. And I think this is terrible that we've gotten to this point where you know, you're a young family, you have 2 kids, you can't buy a house to raise them. Policymakers are telling you to rent, but there's no family-sized rentals because we've never prioritized building them. And, you know, and this isn't normal. I mean, even if you look at New York, I mean, we think about New York as a city that's very expensive. Yeah, it is if you want to live in Manhattan, but if you're in the outer suburbs, houses aren't ridiculously expensive in the outer suburbs. That's why New York's not on that list, right? So, and if you look at a lot of other big cities, their outer burbs are not ridiculously expensive, which is why Toronto's number 5. So I think it's terrible that we're in this market now that is just unaffordable for young buyers tomorrow.
And the mention of rent brings me to my next disheartening bit of information. This is from Statistics Canada. It's about renting versus owning a home. Households who own their homes added over $1 trillion to their net worth in 2020, of course, fueled by this housing boom. Less than $90 billion for renters. Non-financial asset holdings, primarily real estate, but other things as well, like stocks and such, $66,000 per household. Renters, less than $5,000. Steve, does that make people feel about getting comfortable with renting?
Yeah, that's I mean, I think that's the thing is like, again, because it's been like a 30-year bull market basically, and I think everyone, particularly the young buyers, right, they all look at their parents and say, wow, my parents became, you know, multimillionaires by buying a house, you know, 30 years ago. So this must be the recipe for success, and obviously everybody's hoping that continues. But yeah, again, I think that obviously the policies that we've enacted you know, over the last 10 years, particularly since this pandemic, I mean, definitely has widened the inequality. I mean, one of the things that's rather ironic is that, you know, if you look at quantitative easing, QE, it's literally in the mandate. It says, like on the Bank of England's website, for example, is that one of the intended, not unintended, but the intended consequences of QE is to raise asset price values. So, you know, by inflating real estate prices, that's the intended consequence of quantitative easing. So, again, I mean, I just think that these policies have repercussions. I understand that they were probably necessary in some instances, obviously, to get us through this pandemic and recession. But there is consequences for, you know, leaving rates at 0 and printing a bunch of money. I mean, you know, you can't print your way to prosperity. So,
okay, we'll leave it on that point. Thanks so much, John Pasalis of Philosophy Realty, for being here.
Thanks for having me.
And Steve Saretsky of Oakland Realty, thanks so much.
That felt like a dark way to end it. But,
yeah, we ran out of time, unfortunately, but we have a lot to we have a lot of ground to cover next time. We'll be back in 3 weeks, so do check us out. Be sure to check out John and Steve on Twitter. Lots of great information, stats for home buyers, home sellers. Do check them out on Twitter. Follow me on Twitter if there's any questions that you have for these guys. Meanwhile, be sure to check out Yahoo Finance Canada for all your news on things like real estate, the economy, retail, energy, and so much more. You can check out your stock prices, even the price of Bitcoin. Thanks, and see you next time.